All right. Good evening once again, and welcome to this lesson, which is going to be daily buyers. All right. So I think you guys have been requesting this lesson for quite some time now, and today we're going to talk about it. So daily buyers, or how to identify your daily buyers. All right. All right. Now, this is most especially to day traders. Okay, this is most especially to day traders or those who trade intraday or even scalpers, how they can actually identify their daily buyers. All right, so this is very important. Now, with this, we're going to break it down to several steps we can use. First, the first element that we can use to identify our daily buyers is first of all coming from key levels. Okay, now just pay attention closely. We can use key levels to identify our daily buyers. Now, when price is not in a key level, we can use what we call contraction and expansion, contraction and expansion concept to be able to determine our daily buyers. All right. Now, also, we can use candle formations, candle closes, right? Candle closes also to determine our daily buyers. Now, let's start with the first one, with the first method to be able to understand where price will go maybe tomorrow. Like for example, let's say just you get up tomorrow, you want to trade, and then you want to actually know which direction the market is going to take this particular day. All right, tomorrow. Now, for example, if price closes like this today, this bearish, what is the direction that will take place tomorrow, or which direction will price take tomorrow? That's actually what we are looking at. Daily buyers, how to understand. To, like, let's say for example, this is today. What direction am I going to be expecting to trade in today? Am I going to be buying today, or am I going to be selling today? All right, many people use so many methods to be able to determine this. Some use either data ranges and so many other things, but these are the most important elements that I personally use these three. Okay, I personally use these three elements to determine my bias for the day. And the primary one we're going to be talking about is first our key levels. Now, when it comes to our key levels, we have what? We have order blocks. Okay, when it comes to our key levels, we have when it comes to key levels, when it comes to key levels, we have OBs, all right? We have other blocks, and then we also have FVGs, we have breaker blocks, and then we have volume gaps as well, all right? So these are always key levels, and these key levels are mostly on higher time frames. You don't look at this on lower time frames, okay? These mostly are on higher time frames. Let's just say, for example, like this one here, we had this other block here. Okay, this is an order block. This was a bearish order block right here. Now, when price tapped into this key level, okay, when price came up, tap into this key level, and then we started seeing this rejection. Or let's say, for example, let's just say, for example, price closed here like this. Let me just cut this for a moment. All right, good. So this is today's candle, right? Let's assume that this is what we have today. And yet we have a key level right up. We have a key level, which is a bearish order block at the top of this candle. But now you can see how bullish this candle already looks like. This candle tells us that the volume is heavily bullish and price should continue to push higher. But then we have a key level. Now, what this means for me is that I am expecting what? A reaction and probably a sell from this key level. So what this simply means is that the opening of the next candle, I'm going to do what? Expect price to tap into the key level, and then I start to get my rejection, right? So which means as the next candle opens here, I'm going to expect it to trade up to that key level, and then I start to have a reversal to the downside, just like we actually saw the candle we saw the candle already. So this tomorrow, I'm not, if this is what I have now in my hands and I'm expecting to trade, I will not have a bullish bias, right? Which means I will not want to buy into a key level because sometimes price doesn't fully mitigate key levels like that. Maybe it will come right up to somewhere and stuff like that. So which means that as a trader, you always want to trade when price is on a key level, or either it sweeps liquidity and other things like that. Now, you also know about CRT. You can assume this candle to be a CRT already, but then what I will not do here is buy. Okay, which means this new day, remember this is a daily time frame, which means this new day, I'm not going to be expecting to buy, but I'm expecting price to push higher into a key level and then I sell off, right? So which means that right now my bias for tomorrow is bearish, or my bias for the next candle is bearish. But then I'm going to be more patient because price could do something like this. Price could open, trade up, and close like this. Okay, before the next day will be bearish. So which means that I'm going to monitor the reaction of price from this key level. And if it gives me reasons to sell, then I'm going to sell this particular day. But if it doesn't, and then the candle closes somehow, maybe like some kind of a doji or something, then the next day I'll be expecting further down push to the downside because what? It is the reaction that we are getting from that key level. Let me just say, for example, the candle opens like this. All right, we have it now closes like a doji, something like that. Okay, that's today. It opens straight up to the key level, comes back to close like a doji. Now, at this point, using the last element that I mentioned on how to determine bias, which candle formations, already this is a sign of weakness. All right, though it's an indecision candle, but from a key level, and also this validates our CRT, then the next day we can expect price to do what? Sell off. All right, we can expect price to be bearish. So which means that on this particular day, I'm going to be a seller. And probably the next day, I'm still going to be expecting more sales based on the volumes of the candle that I'm going to be seeing. But remember, the main thing I'm telling you now is this particular day here. Price has not reached a key level yet for us to see if it is closing a doji or whatever. But then I'm not a buyer yet. I'll prefer to do what? Wait for price, trade up to the key level, and then I get his reaction from there. If he wants me to sell, I'm going to sell. And then if price comes down and then close somehow, like it did, let's play that. Good. Now, just like what happened here, look at this. Price went up to the key level. We had a very nice rejection. Now, somebody, or you should not be waiting for someone to tell you that today or the next daily candle should be more of selling, right? I don't believe you should be expecting someone to tell you that today you should be looking for more sales on this new daily candle. I mean, look at the volume of this and the rejection. Now, this doesn't mean that the fact that this bearish candle that you're looking for sales doesn't mean the moment price opens, you start selling. No, there is going to be some bearish PDRs on this candle on the 1 hour time frame or less, where you expect the following day to trade into before pushing lower. All right, so don't just expect price to just open and start selling immediately. Sometimes it will do that, but you have to be patient to wait. You look at the range of this previous day. There's going to be some PDRs on it on the lower time frame where price will open the next day to create the high of the day and then to continue lower. Okay, so this is simply how to use a key level, as to be able to determine your daily bias. Now, let's see, for example, the next candle closes. Now, remember we are bearish, right? Remember we are bearish, which means we're expecting price to do what? Create another lower low right down here. We're expecting price to create another lower low right down now. So at this point, we know that price is going to be pulling down to this level because we are in a bearish trend. But then when price came into the key level, we knew this is going to happen. Now, you could also ask yourself, how did you know that this day will be bullish and this one will be bullish? Now you can see the volume of this candle and this one. You knew already that price is going back for internal range liquidity. And we had a nice, very ordered block here. So this day I could have been a buyer and a buyer here. But then after this day, we are already too close to the point of interest or to the key level. That's the reason why I'm not going to be a buyer anymore, because I'm already close to my destination. I want to now take counter trend trades. Now we have same bigger volume, or we have another heavy bearish candle. This alone is giving us more signs that the next one is going to be more of a sell. And remember, we are targeting this low for, we have already created a valid swing high. A valid swing high is when price creates candle 1, candle 2 higher, and then candle 3 lower. Like this is candle 1, 2, and then 3. This is a valid swing high. All right, so we have already created a valid swing high here, and then we're expecting price to trade to the downside. And we have not had any candle here, which is going to give us reasons to maybe doubt if price is pushing, if price is going to be going back up or down, because we're seeing everything that we are seeing here is a heavy push to the downside. Let's see the next candle. Now, look at this heavy candle, very big, pulling to the downside. Now, look again. I mentioned something that when you are trading or when you see how your previous candle closed, the next day, when the next candle is opening, you're not just forcing sales. You have to know that price is likely going to create the high of the day, and that's likely to do what? Fill up some PD arrays that were formed on the previous candles range, so that when price trades into it, that's where we get some more sales to continue to the downside. All right, take note of this. Is very, very important. Now, look at the range of this candle. Look at the body of this candle. The next day, I am still expecting to be more bearish. Now, in as much as price can do something like this, actually, we might open the next day and then price does something like this. Because we've dropped for about 3 days straight, we can open and then price does something like this. Now, with this day now, this is where contraction and expansion concept comes in. Now, when you're talking about contraction and expansion, it is when price is creating smaller body candles like this. When we are talking about contraction candles, remember contraction and expansion, we don't refer to wicks. We only focus on the bodies. When the bodies are contracting, it tells us that an expansion is on the way. All right. Now, this contracted body on the higher time frame is going to be a range on the lower time frame, which means that when price starts ranging on the lower time frame, that's the time where there is likely going to be an expansion. So when we are talking about contraction, we are looking at candles bodies, not the wicks. Now, if such a candle forms like this, what am I going to be expecting? Since I know that this is my draw on liquidity down here, what I'm going to simply expect is that probably tomorrow might open, okay? Tomorrow might open and do something like this, expand to the downside. But before expanding to the downside, it might actually move back up to this level to do what? To fill this FVG that was created here by this candle. All right, but then since I'm going to be bearish, I will rather wait for price to push up into the internal range liquidity here, which is this fair value gap, probably an inversion, and then we'll take some shots from there to continue down, which means all these days here, I don't have a reason to be doing what? To be buying yet. So I'm still very much bearish. Okay, I'm still very much bearish. Now, also something could happen that you have price will give you something like this. Let's say the next candle opens and then it trades back up like this and then gives us what? A bullish engulfing. It engulfs the body of this candle. What do we start to expect now? At this point, we are not just going to turn bullish, but we know that this bullish engulfing pattern here is signaling higher prices. But since we are bearish, we're going to be more careful here, because price can still trade lower like that, despite the engulfing, because it's against the overall direction. So, but when we see such heavy push to the back to the upside, we're going to be more careful not to start shifting our bias just because of that candle, which is forming against the overall trend. All right, if you study a chart, you're going to notice that you're going to have engulfing patterns against the real direction of the market. So what do we expect the following day to happen? Let's see what happens. Now, okay, exactly what we discussed. We're having a contraction, 3 contractions, 4, 5, then boom. Now, when price starts contracting like this, all right, remember I mentioned this. When price is contracting, that is giving us indecision. It's giving us that indecision knowledge. It's telling us that price is a little bit indecisive. We don't know if the expansion is going to happen the next candle or not. But you can see here, price contracted for about how many days? 5 days before actually expanding. Now, when this was a reaction back to this other block, but then you wouldn't have been able to know if this is going to be the expansion candle or this one till this happens. But then we are looking for more bearish signals. Now, unfortunately, in the course of these contractions, you might take some couple of losses, but that's how trading is, right? But now, when it reaches at this level where you have this expansion to the downside, what again are you expecting? All right. When you see the close of this candle, candle closure, very important. What else are you expecting? Knowing that this is our drawn liquidity, and then you seeing this type of candle formation. All right. Just looking at this candle formation, we already expect our buyers the next day to be what? Bearish. Now, unfortunately, like I mentioned earlier, you can actually still have a long bearish candle like this one, and then the following day something happens. This price can maybe slow down with a push to the downside and create something like what? An indecision. And then maybe the next day now it does what? It finally expands to the downside. But before that, let's look at it. Let's see what happens in the next candle. But just looking at this candle, I'm going to be looking for more sales the next day. Remember, this is the daily time frame. Okay, good. Now you will notice that price opened this day, traded back up to this point. Why is it trading back up to this point? Remember, this is the range of the previous candle, and I mentioned that within this range, probably on the lower time frame, you're going to have what? Candle PD arrays or some imbalances where this day will rebalance and then continue to trade in that direction. So this particular day, the fact that I am bearish doesn't mean the moment the market opens, I'm just going to hit some sales. No, I'll wait for price to create a high, definitely into some PD array that was left on the previous candles range, and then from there we continue to sell. Okay, now you look at this candle and then look at where we have our drawn liquidity. Now, what do you expect? A bullish price movement or a bearish price movement? Let me see a comment. Let me see a answer on the chart. Do you expect, what is your bias for the next candle? Bullish or bearish? What is your bias for the next candle? Bearish or bullish? Bearish or bullish? Good, bearish, okay. Let's say bearish. All right, so it is still very much possible that even though we expecting price to push lower, remember, price can still form a contraction candle. That's why we included contraction on this. Price could still do what? Come to this point, the next day open, and then end up creating a contraction candle. Maybe it can create a small bullish candle like this to do what? To trick people to start looking for buying opportunities and thinking that this is what? An evening star or whatever, and then expecting the next candle to continue up like that. But what will happen is, since we are closer to drawn liquidity, as people see that bullish candle, what are they going to be expecting? Probably that price should go higher because they look at this area and it looks like can be an area of resistance. And what are we going to happen to see? Price will expand to the next day. That's the law of contraction and expansion. When the market is contracting, what we are expecting next is what? An expansion in the direction of the higher time frame or in the direction of the order flow. All right, to follow the institutional order flow direction. So with this movement, I would also be bearish, but not saying that we might still not have some like kind of like contraction and so on. All right, why? Because this is an area of what? Resistance or support, sorry, and people will be looking to buy, so which means we're going to have some buyers here, and price might notice that and then give us some kind of an indecision, or if price just breaks lower, that's still good because that's what we're expecting. Okay, even though this looks like an area of support, we are not supposed to be buying here because we know where price is going, right? So let's see what happens this next candle. Good. So the previous day, the next day, the market pushes lower. Now, this is just based on these key levels. All right. We have explained how to use key levels to determine our daily bias. When price trades into a key level, either up, order block or fair value gap, you study the closure of that candle that trades into that zone. When you study the candle closure of that candle, it will give you information on what to expect the next day. You can have a huge rejection. That huge rejection is showing that price is willing to respect that zone or that key level. And then we expect opposite price movement the following candle. All right. Remember, daily bias, you are using higher time frames. You're using higher time frame. You're using the daily, maybe even the weekly to forecast for the day. Now, maybe on the weekly time frame, you notice that we are going to have a bullish week because what we are explaining on the daily here, you can use it on the 4 hour as well to determine the next 4 hour candle. You can use it on the daily to determine the next daily candle, which is what we're doing. You can use it on the weekly to determine the next weekly candle. All right. So basically, we have talked about our key levels and how we can use them to find out price movement. Like, for example, look at this one here. Look at what we have here. This is what? This is our FVG. All right. This is a fair value gap, and this is also a key level. All right, this is a fair value gap and this is a key level. Now you are going to notice something. Look at the reaction of price when it came into this zone. Price came into the zone and formed what? Contractions. The contraction comes, I say forget about the weeks when you're talking about contraction. Now, look at the bodies of the candle. This is contracting, and on the lower time frame is a ranging market. And what happened? After the range, we had an expansion to the downside. Okay, I understand this very well. Now, the fact that also here we had this serious bullish candle. We had this serious bullish candle. Doesn't mean that the next candle should be bullish as well. You have to understand where the bullish candle traded to. All right. And in this case, we took out liquidity here. We took out liquidity here above this high, and then price started to reverse. Okay. Now, also this liquidity that we took from here, price took the liquidity into a key level. Let's quickly look at that and then see. Good. This is still the area. Remember, this was the liquidity high. This was the liquidity high right here. And then look at this. Price took out the high into this fair value gap. So if you go back to the daily time frame, you're going to notice that we had this heavy push candle. All right, this candle that was heavy, pushing to the upside, went into a key level. And look at the reaction of that key level. So the next day, nobody should be there to tell you that we are expecting more bearish movement. And then unfortunately, what happened here? Bullish engulfing happened. But does this mean that price should go against the monthly key level? No. That's why suddenly we saw price started to contract. The buying volume lost, went out, and then what happened? Heavy bearish candle. And only with this, knowing that there's a reaction because of the higher time frame key level, you can expect the following day to be bearish as well. And when price traded into this key level, we started seeing some little corrections. When it traded back into a key level, expansion. All right, so understanding daily bias, you have to use your key levels very well. Now, there are times that price will not be trading into a key level. And in this case, you'll be using either a draw on liquidity to determine what price should do next. Okay, what price should do next. Just like, for example, here. All right, remember that right up here, we are having, let me increase that to 4 and then make it dotted lines. So to the dotted lines, that was the monthly fair value gap. So price was being drawn to what? To the monthly fair value gap. But then look at something along the way. Price started contracting here. Contraction, expansion, right? But now, look at this area. We also had this one, bullish engulfing after price filled this FVG. So after price filled this FVG and you see this one, you know already that tomorrow you are likely to be bullish. You are likely to be bullish. you're likely to be bullish, and so on till price reaches the key level. So even you're looking at this point, you will notice that this candle that you were expecting here, it's not because price is reacting to a key level. It's because we are having a reaction from a key level and we are heading somewhere. We're heading somewhere, right? So it's, I don't know if I should say it's that simple, but it's literally that simple. Understand candle formations, understand where the market is coming from. Like, for example, here, the market is coming from a key level. You see a bullish engulfing, price contracted. Now, with a contraction and expansion, you focus on the bodies. When there is a contraction, there is likely going to be an expansion. And where is that expansion going to happen? In the direction of the IOF, right? It's going to follow the IOF. That expansion is following the IOF, and that's what we had here. A couple of candles expanding to the upside. And that was not just the beginning of the push, which was going to fill the monthly. Price started right down from this point. Okay, now look at this area once again. We had a reversal. Price came back, filled this fair value gap, and ended up as a contraction candle. What do you expect the following day? Now, take note, looking at this contraction candle, we had an FVG that was sitting above these candles that was not filled. Look at that, very clean. And then look at all this imbalance here. Price respecting this one and closing bullish. Those CRT traders, you already know what that means. And then today we are going to be bullish. That's simple. Today we are going to be bullish. And then what happened? Price traded into the other block here, filling the fair value gap, and the bullish momentum slowed down, and we had the contraction. This is to show us that there is a likelihood of a reaction because of this key level. And then we knew after the close of this one, there was an internal range liquidity fair value gap was formed, contraction, expansion to fair value gap, and then continuation back up. All right, that's I would just say that it's that simple actually, but when you back this enough, you're going to notice that it's really simple. Okay, I think I've talked about all of these things. Key levels are very important. You have your key levels, order block, fair value gaps, breakout blocks, and so on, volume gaps. When you see when price trades into a key level on the daily time frame, you study its movement, study its reaction at that key level. All right, there is probably sometimes it can close so heavy into that key level, and then the next candle does what? Start rejecting off. When it closes, you understand what to expect on the next candle to come. All right, it's that simple based on key levels. Now, with contraction and expansion, when there is a contraction, there's going to be an expansion in the IOF direction. Okay, price will always follow the institutional order flow. So, which means when price is contracting, or when price is contracting, when you start seeing smaller body candles, there is a likelihood of an expansion that is about to happen. Okay, and that expansion will do what? Will happen in the line of the institutional order flow. You look at an order block here. Look at what happened when price traded back up into that order block. You can see with heavy volume what happened. Price started forming smaller body volumes, which is a contraction. And then what happened? See this heavy bearish day. And as a result of a key level, when this bearish day happened, already we were targeting this low here. And what happened the previous day? The next day, you are going to be still a seller. All right. Now, also note here, when this is happening, where is price trading down to? That's the question you ask yourself. All right, where's price trading down to? And I believe we had a weekly nice key level here plus this order block here. When price came into the order block, what happened? We formed another contraction, and the following day, as a reaction to a key level, we had price pushing back to the upside. Guys, it is really that easy if you backtest and then you know what you're expecting. Now, sometimes you're going to expect what? Sometimes you're going to expect that tomorrow will be bullish, just like here. Price filled this fair value gap. Okay, and then gave us a bullish engulfing pattern. The next day, you were bullish. That was good. The following day, you were supposed to still be bullish. But what happened? We ended up closing as a contraction. The next day, we ended up going bearish again. But then that was a retest to this model one entry. And the following day, we went bullish. Okay, now look at this candle. Then tell me what you will be expecting the next day. more higher prices to take out the buy side liquidity. All right. I believe this topic is not that difficult, but you just have to pay attention, practice, and that's just basically it now. If you have questions, you can ask them, put them also on the comment section, and we'll try to answer them as fast as we can. So the lesson was not long, and it's not supposed to be a long lesson, but if you have if you're confused or you have more questions to ask concerning this daily buyers video, I'm going to we're going to have another class on it. All right. So no questions.